Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominic Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominic Tavella and Michael Hartzman.
All right, I'm Michael Hartzman on as always with my partner, Dominic Tavella. How are you, Dominic?
Doing well, Mike. Good evening. And how are you enjoying coming back to work after this nice long holiday weekend?
You know, it was a nice long holiday weekend. I hate to admit, and I hate when people say, okay, it's Labor Day, the summer is over. We saw plenty of summer days, but I guess for all intent and purposes, with football season starting and baseball winding down, and I don't know if fall TV is still a thing, Dom, but I used to love the fall because we get that big, thick TV guide and would be all the new shows. So I don't know if that's a thing anymore, but I guess fall is right around the corner.
We are here and the weather has changed from a beautiful weekend to now a rainy, miserable. It looks like might be weak, but the markets haven't changed, Mike. And unfortunately, we're going to spend a lot of time talking about that tonight. The market's mood has not changed, and it's cloudy and a little gloomy out there right now.
So last week, we talked about the unemployment report coming out on Friday and the expectation that maybe, good news would be bad news or bad news would be good news because in the twisted reality that we deal with in managing money. But none of that appears to have happened, Dom. Bad news is bad news.
So the numbers are ugly again. The markets overall had another, the prior week on the average, the major indices were down about 4%, and they came close to pretty much repeating that last week where the major indices were down 3 to 4% again. And I dare say the S&P is down 9.5% off of the August high. So we've seen a pretty decent pullback in these markets. And I'd love to say nothing that is surprising because you and I have spoken about this quite a bit for quite a long time now. This was expected, but it's still a little stomach churning.
I guess if you want to try to put a little good news on this, if it does happen, is we are precariously close to retesting the lows, which was, I think the S&P got to right around down 20%. So today was down again. We're still not quite at 20%, but off the top of my head, we were down 16.8 by Friday. So let's call it 17 and a half or almost 18 at this point. So maybe if the market bounces off of these lows, that could be taken as a positive. However, if it sets new lows, new recent lows, I don't know, Dom. I mean, what happens after that?
Well, there's some technical indicators where the S&P might go. Of course, we joke about it, but it's not a joke. We don't have a crystal ball. We can't predict it. We do know that we get some pretty important inflation data next week, and then we expect the Fed to react to that. And I think this is what the markets now are stressing over, worrying about is, again, how aggressive is the Fed going to be? How aggressive in their interest rate tightening policy are they going to be through the end of this year? And that really says it all right there, Mike. It's you tell me which side of the fence the Fed's going to be on, and I'll tell you where the market's going to be at the end of this year.
And I do think that the market, or at least the experts, have begun to calm down about inflation in and of itself. Because some of the data last week, some of the payroll numbers got a little softer. The employment number wasn't horrific from an inflation point of view. So I guess the economy is weakening, and that could be taken as good news, right?
No, that's a strange world we live in, right?
Right.
You would argue that the economy weakening and that the employment numbers being good but not spectacular, that you would argue that this is not really good news, but it would be good news in terms of further interest rate hikes by the Fed.
Exactly. It takes the pressure off of the Fed, but we can't help ourselves. So then the next wall of worry would be, well, hey, if things are softening, are they going to soften too much? And are we headed towards a recession? And I don't know right now if the market is just in a general malaise, if it has to retest the lows, if it's worried about inflation, if it's worried about recession, or just all of the above.
I'll give you my opinion. All of the
Please.
above is the easy answer, Mike. We normally are at a seasonal time where, markets tend to be a little bit soft and a little bit sloppy. So I think that's part of it. But we have these two camps right now on Wall Street, that the camp that just is adamant that the Fed is going to screw this up and the Fed will over tighten and the Fed is going to push us into a deep recession. And then the second camp that says, hey, maybe the noise and the news is not so bad. We're starting to see inflation roll over and could be significantly lower by year end. I don't want to use the word soft landing, but maybe the landing won't be quite as harsh as some are predicting. So these two camps seem like they're fighting on a day-to-day basis to see who is going to be right. We'll see. We'll see.
So
we obviously
tonight,
have our own opinions, but we'll see where this ends up.
well, we do have our own opinions, and there's a guest, our guest this evening. We both value his opinion greatly. He's been a frequent contributor. He's a friend of both of ours. It's a Phil Blancato, the president and CEO of Ladenburg Thalmann Asset Management. And we will spend plenty of time figuring out what he thinks about all the above.
Phil's got this talent of kind of explaining things in a way that even I can understand it. So I'm very much looking forward to his opinions on the subject, and not that he is necessarily right all the time, but I think he'll bring a real common sense approach to this.
All right. No, as you said, none of us have a crystal ball, not even Phil, but hopefully he has some insights that we haven't thought about. So we will be right back right after this break.
.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominic Tavella and our guest this evening, Phil Blancato, the president and CEO of Ladenburg Thalmann Asset Management. How are you, Phil?
Well, how you all doing?
Welcome, Phil. I'm happy to have you here tonight. I think we can use a lot of your wisdom.
Well, I appreciate it. It's fun to be on with you guys, and thanks for having me back. It's a pleasure.
You're welcome. So, Phil, when Dominic and I did the open, we were really talking about the market just seems to be drifting right now. I know it's the end of summer. We were trying to figure out, and are we retesting the lows? Are we worried about inflation? Are we worried about a recession? Is there just no conviction? Or is it just simply all of the above? So the floor is yours.
Thank you. I appreciate that. When you look at the totality of all the information that's out there, everything you just mentioned, you kind of wonder which of this is most important. And it really just comes down to one most important factor and then three underlying components. Far and away, the only thing that really matters is inflation, because never in your lifetime have you had a scenario where the Federal Reserve is hiking interest rates at a time of such low unemployment. At the same token, slowing economic growth. It's usually quite the opposite. You think about what the Federal Reserve does is they raise interest rates to stem inflation, but also slow down an overheated economy. So when you think about why, how did we get ourselves here? It's obviously the residual impact of the pandemic. And interestingly, there's very little the Federal Reserve could do to fix supply chain issues, or for that matter, oil or gas issues. And yet here we are in this constant malaise of, is this supply demand driven issues? Meaning, is there more stuff people really want, or is there less stuff that people really want? Is it driven by how much stuff we want to buy? So when you put it all together, it comes down to one factor, inflation, and whether or not the Federal Reserve can have an impact on it. And I would argue that for the last 12 years, we have all enjoyed the free lunch of the Federal Reserve printing an excess amount of money from 2009 to today. And you were seeing this in your 401ks and your IRAs and your investment accounts of returns in excess of 30% some years, 20%, which is not the historical norm. The average return of the S&P 500 going back 50 years is 11%. It used to be 8 before the last 10 years. So now we're on the other side of that, with the Federal Reserve getting out of the way at a time when they need to break the back of inflation. It's creating this very unusual economic environment where, for the first time in your adult lifetime, you've never lost money in both fixed income and equity to this degree at the same time. Never happened before. Hasn't happened in 48 years, and never to this magnitude. So that's what we're dealing with, Mike. It really comes down to that things this time are new. They're different. And as I'm watching them heal, I would argue it's the best investment opportunity since the fall of 2020. I think you have a chance to buy stocks really inexpensively. I think you should commit to the equity market here. I think you should be very careful of your bond portfolio, with a great opportunity to add to your bond portfolio soon, not quite there yet. But it is in this environment when the noise of the social media, financial press gets so overwhelming that it just scares the heck out of you, when that's not what you should be doing now. You should be looking at this as volatility being your friend, not your enemy, and take advantage of it.
Bill, so, we speak frequently and privately about, I've been kind of optimistic towards what this market is going to look like by year end, but I won't lie to you, there's a part of it that scares me, and that is the Fed is fighting this thing, and they're trying to do it as aggressively as they can, but now you have an administration that is continuing to spend money, continuing to borrow money, and continuing to add fuel to this economy. And is it ultimately a losing battle by the Fed because somebody else keeps pouring gasoline on the fire?
And I would guess I would take the other side of that. The student loan forgiveness, which I think is what you're pointing towards. Yes, it's problematic, but it's not going to fuel the inflation issue today.
But look at the two bills prior to that, Phil, and we don't even know yet about the student loan forgiveness. But the two prior bills, whatever they call them, the inflation fighting bill and I don't even want to get caught in the semantics, but they potentially could add another $1 trillion of spending way before the economic impact of maybe tax increases even comes into this picture. Does that worry you at all?
It doesn't. It's only $380 billion over the next 5 years, and then it would accelerate after that. At a time when your GDP is closing in on $26 trillion, it's a drop in the bucket. It's not substantive enough. It just isn't. What you need to focus on here, in my opinion, is not these temporary bills. It's not the $2.5 trillion, which would have worried me. It's a much smaller bill. Remember, government spending is a stimulant to the economy at a time when you have a slowing economy. 70% of our economy is consumer driven, and the other, call it 20%, is driven by spending at the federal level, and the other 10% is discretionary miscellaneous spending, leaving aside the money spent on Medicare, and Social Security. So government spending is never, it's an ill as long as we don't overspend beyond our budgetary capacity. And I would argue that I have never been concerned, and someone on your call tonight might throw something at their radio right now or their phone or whatever. I think the amount of debt we've added is irrelevant, because you're financing the debt for 1.5%. It's the lowest amount of financing in history. The amount of costs we have, the debt payments we have versus the size of our economy is the smallest it's ever been. It's irrelevant today. Someday it could become very relevant if interest rates push higher. But in a deflationary world where every developed nation in the world, including China, is faced with a demographic time bomb, we're importing deflation. We're exporting deflation. We were deflating before this event, and we will deflate again. I'm not worried about that. What worries me more, I'll give you something. If you want to talk administration for a minute, one thing I've noticed administration that I'm sorely disappointed in, and I think there's more to this story than how I'm going to phrase this, so couch this for a moment. If you look at the number of acres released by this administration, it's a fraction of that every other administration that came before that. For example, Ronald Reagan released 48 million acres for exploration of oil and gas of federal land. This administration has released 124,000. Every single president, going back to Kennedy, released in the millions, with the lowest being Donald Trump came in at 4.4 million. Before him was Nixon and Johnson at about 2 million at a different time. So at a time when we have the opportunity to stay in the pole position from world economics, there's been a lot of rhetoric recently of two debates. Will China ever take the United States? There's a debate right now that they won't, and there's another debate that they will once they come out of this. I'm on the camp that they never will. But it's because of the ability for us to sustain our oil and gas. Put in a different way, Europe is on the precipice of a total collapse because they're about to pay 20 times more for oil and gas right now than they did a year ago. unsustainable. It's why the euro's fallen below the dollar, and the sterling, the pound will soon as well, unless they decide to mine their own gas, which they have. They just refuse to do it. So that to me is, if you want to point administration, that's a worrisome economically and worrisome from an administration standpoint, that it's a policy that we're just not ready for yet. The debt issue to me isn't as impactful as it's been made out to be.
So Phil, just to stay on the debt issue for a moment, many of our clients still have the belief that the Social Security system is going to go bankrupt in 8 or 9 or 10 years. It's a story that pops up every now and again, but I feel like 10 or 15 years ago, it was a constant story. So I think we do a good job of reassuring our clients that you know, they're not going to run out of Social Security. Their Social Security payments will continue, and the government will always be able to support that. But do you even look at Social Security when you look at the debt, or is that one of those sacred cows that will always be paid attention to and funded?
The latter. The sacred cow of Social Security will always be something that you're never going to get away from. Will there come a time when there's going to require significant pain in the distribution of it? Yes, and that's 2030. So for those of you who are collecting your payments now, I think you're safe and secure. It is those who have yet to collect that you're going to look at it. It's already happening to a great degree. You're seeing the ability to maximize your Social Security benefits be pushed out to 67, 68, 69. But there's going to have to be much more turning of the dial here, because you know the trust fund runs out of money as of right now, 2030. It was 2032. It's been backed off to 2030. And the latest projections, honestly, are 2029. It's the third rail that no one ever wants to touch. But I do believe there will come a time when it's relevant. The only thing that gets us away from this is our ability to manufacture debt today is far and away the best in the world. You see, inevitably, you are the best house in a bad neighborhood. If you have a choice between owning debt from the European Union, debt from China, or debt from Japan, you want to own the United States debt by far. It's the strongest economy in the world, the strongest consumer, and the one paying the highest interest rate in most cases, by the way. We pay our yield on the 10-year US Treasury is 3.35% as of today, where the German Bund still yields around 1%. So that's our ability to manufacture debt doesn't seem to go away. It's why I tie it back to energy and economics and our consumer. As long as we as a nation realize that demographics matter, continue to grow in population, not shrink like Europe, Japan, and China, then we'll always have the ability to have a very strong consumer, as long as you have your own energy and natural resources to support that consumer and manage inflation or lack thereof. So it is something I worry about much more so than the debt, but I think it's something that can be fixed through age adjustment, to those who haven't taken their benefits yet, through probably a cap for folks who make more than a certain amount of money per year. That's probably something that would happen. But then ultimately, the benefits are being pushed out further into when someone could start.
So one follow-up question to that, you know, George W. Bush, and I thought it was a good idea, you know, kind of wanted to individualize the Social Security system, give individuals a little more empowerment on how that money is handled. You know, that was 25 years ago. Is that ever going to be back on the table, or is that dead and buried?
Unfortunately, I don't believe they'll ever get there. And the reason will be not economic. Well, I think policy-wise, it was an interesting idea. We, all three of us, know our lens, it makes a lot of sense. We come from financial services industry. We manage people's money for a living. The average person out there, of the 332 million Americans, I would bet 75% don't have fundamental understanding of what the stock market is, how it can benefit them, and how to utilize it. So that inability to educate people as that power of investing, more so than real estate or your local bank, your CDs, your stuffing it in your mattress, is, I think, still a foreign concept for people who make less than $100,000 a year. And for that reason, I don't think it will ever work.
Phil, I like your comment about the best house in the worst neighborhood. Was that?
Yes.
Yeah.
Yes,
So it's no wonder that the dollar has been so strong. I can't even remember the last time the euro was less than $1. But do you worry about the multinationals and them being able to sell globally? And what does that do to earnings for the S&P 500?
You know the irony of that? If you look at the S&P 500 year to date, which companies have better earnings for the first 2 quarters? Companies that have greater sales overseas internationally than it did domestically. Why? Because last year Americans bought more stuff and this year Europeans bought more stuff. So ironically, even in spite of a strong dollar, it has supported the multinationals. But you're right. At a time when the dollar is strong, inevitably our exports cost more, and then couple that with other countries in the world dealing with an energy crisis, specifically Europe, you would assume the multinationals are going to suffer. And I would agree with that. That's why today I think your portfolio needs to be dominated by US stocks. The bulk of your equity exposure should be, if not 100% in US companies. And I think you want to emphasize companies that pay a large dividend and generate that dividend from consumer spending in the United States. There is an opportunity environment like this to focus on where the revenue is. And I think you're right. The multinational environment's a concern. It hasn't been so far this year, but the table's set for that. And to your point, this is the first time since the euro came out that the dollar is stronger than the euro. And in our lifetime, we've never seen the pound fall below the dollar. And I'll bet you $1 by the end of this year it will.
If you don't mind me following up on that, Mike. So, we were fortunate enough to really underweight, if not eliminate, international exposure in our client portfolios. And you see Europe is going to be in a recession if they're not in one right now, and what's going on in China. But we're starting to hear rumblings that there might be opportunities out there in the international space. I'd love to hear your thoughts on that.
Cheap for a reason. Inevitably the Labor Day season from a travel standpoint was arguably going to be the greatest Labor Day travel season in the history of the country, dollars spent. We're seeing revenue at hotels and nights booked being the highest they've ever been. And a lot of that spilled over into Europe. So some of that will make its way through Europe as U.S. consumer, which today represents 25% of global GDP, 70% of U.S. GDP. The U.S. consumer is far and away the key driver for growth in the world. But international has its issues with that. It's built on legacy manufacturing and not technology. It's old manufacturing. And in that sense, it does pay a decent dividend. But at a time of global recession, when you look at China's GDP falling potentially below 3%, Europe on the cusp in a recession, if not already really in one, it's hard to make the case that Europe is not cheap for a reason. And as long as the dollar stays king, the conversion of your dollars into their stock means you lose money when you buy their stocks. And for that reason, I think it's cheap for a reason. I have spent my career, my 32 years of doing this, with a hefty allocation international. It's the first time, like you, in my career that I haven't had international exposure in the portfolios, really for the better part of 5 years, but none at all in the last 2 years. And as much as I'm a fan of emerging markets, specifically China, 1 billion people that have become consumers and less laborers that are going to buy things, it's hard to reconcile the idea that when a dollar is as strong and manufacturing is weak, and partially due to the cost of energy and still the malaise of COVID, especially in China, that's the hard market to bet. You'd have to be very patient. I'd rather make a bet on growth stocks in the United States, inexpensive technology companies that are going to be the drivers of tomorrow is a much better opportunity, in my opinion, than making a bet on international that hasn't paid dividends in many years.
Agreed, Phil.
Phil, you mentioned a few minutes ago dividend payers and in sectors like energy, and you're concerned about inflation and interest rates, but you also sounds to me like you're teeing up your clients for a possible recession, because aren't those the places you want to be during a recession as well? Consumer staples, energy, dividend payers, because those value type companies are more reliable when the economy starts to weaken.
Yes and no. I wouldn't call it recession. I don't think we recess. I'd be willing to bet a bunch of money we don't recess, because the classic definition didn't apply this time around. What's forgotten about is the reason why the first quarter was a negative number was because of the exports that we sent out versus the imports that came in. And that's because of the strong dollar. You don't get recessions when your unemployment rate is 3.7%, 700,000 people come back into the labor force, your participation rate is nearly 63%, your wages growing at 5% per year, and the consumer having a debt to asset ratio of maybe the greatest of our lifetime. That doesn't work that way. And that's why you saw the jobs number come in so strong, lower than the prior month, but still quite a strong number. But what you do get, Michael, is stagflation. And stagflation means at a time when the Federal Reserve hikes interest rates and growth flattens out. So in other words, you've gotten to a point where certainly there's not been any growth in the last 2 quarters. You might get a little in the third quarter here, but flat growth, flat revenue growth with cost still pushing higher is stagflation. What do you do when you stagflate? You wait around. How do you wait around? You don't go to cash. You go into companies that'll pay you dividends to wait this out. And that's the positioning. And then you got to focus on valuations. Where is it inexpensive? Where are you paying a fair price for a company? And you want to look at your PE ratios. You want to look at cash flow. You want to look at where the consumer is spending their money. And you see it. It's a living cover. Where do you, the folks listening today, where are you spending your money? That's where you want to bet on stocks right now. It's the places where the consumer is strongest and you get a nice dividend to wait out volatility. That's how volatility becomes your friend, not your enemy.
Hey, Phil, so I want to go, I think we're on the same page on this one, but I guess I want to make sure, number one, year end, we're thinking inflation is still relatively high, but lower than where we are today. But the growth is not really going to be, anything substantial. Let's just say that, plus or minus around break even. So the $1 million question is, what does the Fed do when the economy is barely growing, but yet inflation could be still 5+%?
It's a good question. Give me an example, and we're on the same page too. I think to a degree, but I'll try and answer both. Have you noticed shipping rates? Shipping rates were into $20,000 per container from China to the United States. They were $2,000 pre-pandemic. They've fallen now just about 70% to where they're just under $5,000. So from 20,000 to 5,000, it's an incredible collapse of the prices of them. Then you look at every other shipping area in the world, to Europe, to the Mediterranean, all down anywhere from 40 to 60 to 75%. So great indicator of how inflation, the back of inflation is breaking. Commodities markets all coming down. Lumber markets have come down across the board. So your inflationary number for the month of August is probably going to be under 7%, if not on its way to below 6%. I care a lot more about PCE, personal consumption expenditures. If you're a listener tonight, take some time and learn about PCE. It's really much better indicator than CPI. It's what the Fed looks at. It's basically when you take out food and energy, the stuff it really costs you to spend money on when you're going to supermarkets or local goods. And that number's come down quite a bit. So to answer your question, Dom, it's not that inflation is going to go back to 3 or 2 by the end of the year. I do think it goes down to sub 3 by the end of next year. And I can explain why in a minute. But more importantly, what the Federal Reserve needs to do is recognize they've done a lot of work. And they're going to come out in the month of September, I believe, and say, we've done a lot of work, and we're going to go 0.5%, not 0.75, because they're seeing inflation trends come down. And then they're going to come into October and they're going to pause. They're not going to hike in October because the rate of decline, if energy continues to go down at this rate, that's my big if, we'll say to them, we've done some work. We want to see how much the impact is. Couple that with, remember, the seasonality in oil. The weakest demand of the year for oil and gas is September, October, November. Couple that with the Federal Reserve that may go on pause on October. Add to we're in the midst of the biggest buying season of the year, and the stock market roars. So it's not that we need inflation to break. We just need inflation to recognize it's breaking and pause, and the stock market will turn on a dime and rocket higher.
So the call, just sorry to follow up on that, Mike, the call is the Fed does pause?
My opinion is they go 50 basis points, 0.5% in September, and pauses in October. Worst case scenario, they don't pause in October, but they say they're going to pause in November. They forecast the fact that inflation is coming so much, they're done and going to wait this out and let the market rise into the end of the year. Remember, the Fed doesn't want to also destroy the wealth effect. You've got lots of folks who made a lot of money in their 401k. They don't want to see that eliminated. They want to break inflation, and they're willing to cause some pain in the labor market, and arguably they have. Instead of adding 500,000 jobs a month, we've added 200,000 to 300,000. Wages have capitulated. We're seeing wages flatten off and come back down. We're seeing rents come back down a bit. We're seeing prices of new homes and used homes come back down a bit. So the Fed's actions are beginning to work. So they don't want to overshoot here. And I would believe that there is a possibility, and I think a strong one, of then creating what's called a soft landing, putting us into an environment where growth moderates, inflation breaks, but we don't fall into a dramatic recession. The labor market is going to be your bellwether. And in the temporary job market, watch temporary jobs, which continue to add people every month. If temporary jobs begin to slow down, then the Fed is overshot and we're going to fall into recession. Temporary jobs maintain and go higher into the end of the year, consumers spend, we're going to be okay.
Well, Phil, to your point, aren't we going into the temporary job season coming up quickly on Thanksgiving and Christmas?
Exactly. So all we have to do is make it through the worst month of the year, Mike. September is far and away the worst month of the year. You look back at history, it's 0.5% on average down. In fact, even worse for your listeners, I hate to break the news to you. When you go into the month of September down, it's down on average 3.5%. So not only is it down on average 0.5%, when the market's down going into it, it makes it even worse. So September's not a fun month. What's the turnaround week every single year, just about on average? The week of October 14th. Mm-hmm. So I would circle your calendar. Let's have a fun. Let's maybe join the call on the second week of October, and we'll pop champagne that day. If I'm right, the Fed begins to talk about pausing, the market capitulates, we rocket higher, and in the year, +3, -3 on the S&P 500. I'll bet someone on this call a buck, +3, -3 on the S&P 500. Not the bond market, but the stock market has one heck of a rally left in it if inflation breaks. If inflation does not break, then we're stuck down here at -15% at least.
So
So,
I'm
go ahead.
sorry, Dom. So
No, go ahead.
what is that number in your mind? Is it 4%? Is it 3%? Where does the number have to come in for, the Fed to have broken the back of inflation?
Sub 5%. If the
Sub
trend
5.
goes sub 5% by the October meeting, they will pause.
Well, that's kind of achievable. I mean,
that-
that's not unreasonable, the rate we're going at.
But it's a 50% drop from the high.
Right.
And it depends on what we call the delta, the speed of the deceleration.
Mm-hmm.
So if you're seeing dramatic drops in it, then that would tell us we're there. Sub 5% the Fed, and especially if we see PCE, core PCE, come in under 3%, the Fed is definitely going to slow down its mandate.
So Phil, I did one of my recent interviews and I got a little kickback because I was saying 5% inflation by year end, and they thought that was exceedingly optimistic. But I'll tell you where I'm worried. We currently have an administration that's releasing 1 million barrels a day from reserves of oil. And that's clearly affecting the energy picture today, and I think gets better through the end of the year. But at some point, they're going to stop releasing that oil and maybe turn it around and actually have to start buying it, and right at a time when Europe is really going to be hurting. Any opinions on the energy picture through the end of the year and the beginning of next year?
Well, to the point earlier, I couldn't agree with you more on that subject. I personally think it's a mistake by the administration trying to be focused more on tax abatement, releasing oil from the National Petroleum Reserves, and trying to work with other countries to produce more oil rather than do it here. I think that's a profound mistake. You see the number of acres have been released. If the administration wants to really break the back of inflation, then they have to come up with a grand bargain with the oil companies, which is some sort of tax agreement or incentive for them to explore, drill, take out more natural gas and oil for at least the next 10 years. The average well takes 4 years to create profitability. So it's not as if they could say, okay, we're going to release 2 million acres here and then all problems go away. It has to be a larger, bigger agreement for that. Now, the energy picker grant scheme can be twofold. You can focus on nuclear, you can focus on natural gas, you can focus on wind and water and solar to get you to the long-term idea that as of 2030, global oil will have peaked and begin to come back down. But in this temporary situation, especially with the war in Ukraine, if we don't help our allies in Europe, they're going to fall into maybe a depression. Think of your home heating bill. If you went from spending $100 a month to $2,000 a month, how would you survive that? It's incomprehensible, not to mention what it would do to demand destruction across the board. So you're right, Dominic. The one thing that's a fly in the ointment for the rest of the world is the price of oil. Where we have an advantage is we can produce enough oil and gas for us to not be faced with that. But inflation may not break enough if, in fact, we don't figure out this oil issue right now. It is a here and now issue. And I think it's why at the polls, the current administration has been suffering. That they're not able to get really gain popularity with both sides of the aisle because of the cost of energy and the lack of ability to use it to fix it, especially when Putin is using natural gas as a weapon, shutting down the pipelines, obviously, and so on. And it could create you could see people lose their lives in Europe because if they get a cold winter. So I think it's a very serious situation. It's far and away, if you peel back the onion and forget about the Fed, forget about inflation, what's the number one focal point you need to have? It's oil. Oil has come down a lot. We can survive globally and get through this at $85 a barrel. Actually, large cap stocks can, from a capital spending standpoint, can survive at $90 a barrel. But we need to sustain this price. The only way to do it is to release more, to come up with a grand bargain and have more acres available for drilling.
Phil, I wasn't going to bring up the midterm elections, but since you guys are both talking about politics, I figured what the heck. Earlier this year, it was expected because in most administrations, no matter who's in office, either the Senate or Congress goes back to the other side. And it looks like, the House of Representatives, will probably go back to the Republicans, but even Mitch McConnell has said it's not a foregone conclusion that he becomes a majority leader in the Senate. For, whatever his reasons are for saying that, I'm not going to get into. But do you look at the midterm election as you look towards the end of the year, and is there a fly in that ointment, which would make you change your view of a year-end rally?
No, because the president would veto, even if both sides flip to to Republican, excuse me, I think you'd have a tough time getting the president to agree on a bill. I think we would look like the second term of Bill Clinton or the second term of President Obama, to a degree, the second term of Donald Trump, second 2 years of Donald Trump. Politics generally, folks, don't really have that much impact on markets. You'd be surprised. You look at when the president's in power with opposite sides or united sides, it can matter by a few percentage points one way or the other, but they don't have tremendous impact. Generally, economics is cyclical. What is different this time is you do have the potential, if the Democrats won the House and Senate, then it would probably unwind the president's tax cuts, President Trump's tax cuts. That's a potential game changer for market stability. And then to Dominic's point about oil, would a new House and Senate that are Republican be able to force the president's hand on drilling more land and making more favorable? I don't think so. So I would tend to believe that midterms don't have enough say-so in long-term economics. It's much more about cyclicality and strength of consumers. So I'm not a political hack. I do think it's worth noting and focusing on. The debt, to me, as I mentioned earlier, isn't a big deal, but public policy on spending is probably the one thing presidents matter. And so far, this administration has spent some money, but compared to other administrations, different timing, COVID, all those other things that affected it, we're not adding to the debt to the velocity that we were under Obama or under Trump, and to a lesser degree under Bush 1.
So to your point then, Jerome Powell and the Fed will do what they have to do in order to break the back of inflation, even as we're creeping up, I think we're 60 days out now, even as we're creeping up on the midterms.
That's a different question. Is the Federal Reserve politicized? Yes, I think they are. I think they've become very politicized in the last few years, to a degree that I think they want to stay out of election politics. So part of the reason why I think they paused in October, get out of the way. Remember, his boss is the president. And just like the prior president, they had no problem telling the Federal Reserve what they think they should do. Whether or not the Federal Reserve listens, or all those governors, or who's up for a seat, or who's got their own political biases, I do believe the Federal Reserve has become politicized much more so than any time I can remember in recent memory. And for that reason, I think part of this plays into, let's get out of the way of the election, which is a positive for the Democratic Party.
So is that maybe the impetus for them not raising in November, Phil?
I would say October, because November would be too late at that point. So I would think that the reason why I think they pause in October is, if I'm right, that inflation breaks, seasonality affects oil. Not to mention, Europe right now is at 88% of their inventories needed to get them through the winter, as long as it's not very cold. If they get to 100%, then a lot of this becomes less of a concern. Oil does stay muted. We don't have as nearly a severe a problem. The United States becomes a major exporter of LNG into the end of this year, into liquefied natural gas, and more so even in next year. So then you have a scenario where it's a win for the American economy by exporting liquefied natural gas, and assuming the administration lets that pass. But I think what's interesting is the Federal Reserve gets out of the way, because inflation breaks and we're in election season. It's a big win for the Democratic Party.
And a big year-end rally.
So that's exactly what I was going to ask you. You're pretty bullish about a year-end rally, and I'd love to hear that. Is there anything that could throw that off the tracks right now?
Oh, for sure. If the Federal Reserve, if I'm wrong, that they're not politicized, or even more importantly, that inflation doesn't break, that we don't get to a scenario where we see a significant reduction, sub 5%, sub 3% on PCE, then we're going to end up the year down 15%. We will not get a rally in that. Well, I think we still see something towards the end of the year, but it all comes down to inflation and that oil. Oil has come down. Remember, oil was $130 a barrel over the summer. We're at 85 today. So there is a significant difference in the price of oil. And if we can get now Brent versus WTI, we need both of them sub 85, which is a strong possibility because of the seasonality. Then I would think the Fed would have no choice but to consider pausing. And the labor market has shown a bit of weakness here, which needs to show a bit more for them to pause. But what they want to have happen is beginning to happen. And they don't want to make a mistake by sending us in a recession when they don't need to. So in my opinion, that still looks like it's going to happen. But if I'm wrong, that oil stays strong and the Fed stays aggressive, the market will still continue to sell off.
So Phil, we are bumping up on a break. I mean, this segment has flown by. do you mind sticking around and then you could stay with us and we'll close the show together?
Sure, that would be fun. It'd be my pleasure.
That'd be awesome. So we'll take a quick break and be right back with Phil Blancato.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominic Tavella and our guest this evening, Phil Blancato, the president and CEO of Ladenburg Thalmann Asset Management. You know, Phil, we had as much of a lively conversation on the break as we did when we had you on. So Dominic had an interesting point, and I'm just going to throw it over to him to see if you guys could finish that conversation.
Yeah, Phil, I want to see if we can pick it up from the beginning, but clients are looking at that, whether it's the CNBCs or the Fox businesses or the Bloombergs, and there are some really, and I would characterize them as people that we've been listening to for decades, and pretty smart people and very sophisticated people, but they are really doom and gloom. They're talking about year-end numbers on the S&P that are just downright scary. And obviously there are also the people at the other end of the spectrum, but I would call people I respect that are really talking about gloom and doom scenario by year end. I obviously don't agree with that statement, but why this really negative opinion? I'm sure you hear the same voice as I do, and clients are listening to them, which is even more frightening to me.
I'll tell you a story. Dominic and I both got a chance to do some media work, and I've over the years had a chance to spend a few minutes with a famous CNBC anchor who, during a commercial break, I asked him his opinion on oil at the time. And he said, I don't have an opinion on oil. My job is to sell cornflakes. And it had nothing to do with markets. I would bet most of the folks that go on the financial media that at least work there, their job is to make you watch. And how do you make people watch? How do you make people pay attention to the company with? Well, you spell doom and gloom. So sometimes the media, financial media specifically, have that roaring bear on TV when things are going bad, and they want to tune you in and scare you into nowhere. But it's been said many times, you want to buy when people are fearful and sell when people are greedy. And that's an old adage, because it's emotions that get the best of us when we come to investing, and that's where mistakes are made. And to the point made, what's the bare possibility? The bare possibility simply is when we haven't wrapped our head around yet. It's not necessarily things falling into the abyss here. It's this process of going back to normal. Normal is a tough word in economic terms. We went from 48% earnings growth to this year, the earnings growth in the S&P 500 is probably going to be 7 or 8. Imagine that dramatic come down in that amount. You went from sales growth, revenue growth that was quadruple this year's sales growth. So the process of your GDP going from 6% GDP down to flatter, maybe +1 or +2, is quite painful. So then you mix in the cost of borrowing money has accelerated as well. So you get this scenario where earnings have collapsed, really going back to historical averages. Debt, which was at historical lows, is going back to historical averages, even still slightly below. So being normal has created concern. And then you add in a layer of inflation, which makes it more expensive. And suddenly this idea that the S&P is vastly overvalued. Well, I'll tell you what, let's consider that for a minute. That's true. If in fact we're in a scenario where earnings completely collapse and go negative, then all growth stocks are too expensive, and the S&P will trade at about 3,000, down another 5 to 8% from here. Value stocks, which are only down about 9%, 10% on the year, will probably fall down to about a -14 on the year. That's why I like the dividends you get from it. So there is a scenario where the process of going back to normal means not only do we not get any normalized earning growth, we get a recession. And in that recession, our unemployment market skyrockets higher. And then at that scenario, we see lack of earnings growth, which means stocks are far too expensive based on company earnings. The reason why I push back against that is I just don't think we're going to get a weak labor market. Here's why. We have 11 million jobs open. There's roughly 3 to 4 million people looking for those jobs. So let's clean up those numbers a little bit. Let's increase the number to 6 million people looking for work, because there's probably about 1 million to 2 million still haven't decided to come back yet. And let's assume in the 11 million jobs open, there's probably 2 million that have been there for a while and they're stale and they're not really looking to hire those spots anymore. So let's make it simple. Let's say there's probably 9 to $8 million jobs available, and just about, 6 million people looking. That still means it's a job available, if not a job and a half available, if not 2 jobs available for every person looking. So because of the great retirement boom, the number of people that just simply 11,500 retire every day, I just don't think you can fall in a recession in that environment. But if I'm wrong, If we recess because the Federal Reserve pushes prices too high, oil stays too high, and earnings collapse, the stock market is too expensive and falls to roughly 3,000 on the S&P, where stocks would trade below historical averages on a current price to earnings ratio and a future price to earnings ratio.
Phil, could we just talk about the bond market for a second? I mean, obviously the stock market is sexy and that's what everyone talks about. But we all have asset allocation models. We all print our numbers quarterly, daily, weekly. And if the bond market was not so horrific this year, quite frankly, our overall return numbers will look a hell of a lot better than they look right now. And I know you're bullish about the stock market recovering, and you've been, I don't want to put words in your mouth, but a little bit more cautious about the bond market. What has to change for you to feel a little bit more bullish about the bond market?
I'll give you an easy answer to that one, Michael. I will be extremely bullish probably by the end of November on the bond market. So today, the duration, the amount of time it gets paid for getting my money back in my portfolio, the portfolios we manage, is about 3 years. We have a significant position in floating rate bonds that actually increase the percentage we get paid based on the current interest rate environment. We're getting nearly an 8% dividend out of that portion of the portfolio. We're earning on our bonds today north of 4%. When was the last time anyone did that? And I think there's an opportunity to add duration, go from 3 years to 6 years by the end of this year, because I think the Federal Reserve stops hiking rates at the end of this year. And you'll see the 10-year US Treasury reverse from going from where it's at today at 3.5% back down to roughly 2%, which means bond prices will increase as yields go down. And the reason why they go down, we are in a deflationary world, not an inflationary world. So I will take advantage of the opportunity to add bonds back to the portfolio. Today, my average bond allocation is lower than it's ever been. Roughly what is normally a 60-40 portfolio is only 26% in bonds. The rest are in other things that earn income, like preferred securities and floating rate securities, which are not your traditional fixed income allocation. So for that reason, there is a chance to be bullish on bonds, but make no mistake about it. Never in your adult lifetime have you lost money in bonds 2 years in a row. And that's last year and this year. And I don't think there's a chance you're going to lose next year, but I'm not sure you're going to make a whole heck of a lot. But the bond market finally is a place where you can earn some real income. Look at municipal bonds. You can get yourself a whopping 4% dividend in a muni bond portfolio. That's on an after-tax basis equivalent of 6%. Finally, bonds are starting to look attractive again.
So Phil, we're closing in on the last minute of the show, and I can't help but ask a loaded question. So I'm all in on what you're telling me. I think we're primarily all on the same page, but how does the Fed keep from screwing it up? And that's a question I can't help answering for my clients.
History. Every person at the Federal Reserve is a student of history. They've seen enough of this movie more than once to have an understanding of how to not push too far or not when to stop. And for that reason, I think the Federal Reserve has a better chance than ever of getting this right. And I'll be one of those people that you may not like what I'm about to say. I think what the Federal Reserve has done up to now has been brilliant. Maybe one round of stimulus too much. That's more Congress than the Federal Reserve. Maybe they could have hiked sooner to bring down inflation to a degree. But we would look like Europe or Japan or China had we not printed the amount of money we printed to keep us out of this mess. So I give them a tip of the hat until they get it very wrong. In my opinion, they haven't gotten it very wrong yet.
Phil, we can't thank you enough for popping on tonight. I know you had a busy schedule this afternoon and you made time for us, and we appreciate your insight and your logical approach to how you manage your clients' money.
Thank you. It's a pleasure to be on with everybody.
Well, thanks again. Your words of wisdom and common sense, and I look forward to having that drink and figuring out that we weren't that far off on our call. So looking forward to that.
Me as well. Thank you, gentlemen. It's an honor to be on with you. Really appreciate it. Thanks for the opportunity.
Have a good night, everybody. Thank you for joining us.
Take care.